To you first, Jeremy, your take on what we saw out of BHP and your overall take on the earnings season so far.
Yeah, I mean, from an earnings perspective, BHP delivered on their cost savings. There's no revenue growth to be beating your chest about. And from an investor point of view, a very miserable increase in the dividend. And I know local investors have been begging for that. They didn't get that. They didn't get any sort of strong capital management. What they've got is a demerger, which, you know, I think there's always a particular winner and a particular loser in a demerger, and it's going to be clear to me in the long run it'll be the company itself, BHP, will be the winner. The sundry assets are less attractive. But I think largely I saw some things in the BHP result through this season. Cost management, pretty good, generally speaking. Revenue growth, not so good.
Yep.
But other companies have found their way to increase dividends. BHP, a real disappointment there, and I think that'll resonate here in the Aussie market
which
tomorrow.
is actually coming from Shane. The question reads, car sales and also REA Group, so realestate.com.au, have both had big falls in earnings and then bounced back. Can you guys discuss the likelihood of SEEK doing basically the same thing from their earnings tomorrow? Interesting space is the online space. The three sort of giants, almost gorillas of this world in the Australian listings. We have seen astronomical numbers coming from REA, and you could probably put SEEK on the same line. Car sales has been good, but probably not on the same, you know, movements. Still incredible movements over the last 24 months. Jeremy, to you first on the fundamentals. Where is your positioning on SEEK, and what do you see coming in from tomorrow?
We're long SEEK, have been for a while. It's been extremely kind to us. SEEK tends to exceed expectations.
Yep.
Now, that doesn't guarantee a performance on day one after the result. There's a number of things, and a very good question I might add, because these are all not only darlings of the market but highly rated, and their high valuations can lead to share price volatility around announcements. And so you saw that on the car sales was most profound because it was an immediate sell down and very pronounced sell down, but 2 days later it had grown back all of that loss and been in profit ahead of the result. So that was a case of a high PE stock getting belted just for the way the marginal buyer and seller, who actually determine prices on a daily basis, determined it. Now, I think I'll go with what's happened with the past. SEEK is an outstanding long-term stock. It's highly rated by the market and can be subject to price action. I think it'll perform well. I think there's real excitement and optionality in a number of their businesses. Their Zhaopin Chinese business, which is listed in the US, has performed well and is a great growth engine for the group going forward. What I like about SEEK is its offshore business. That's what's exciting. SEEK International offers enormous upside, and not only in simply the jobs listings market, education and businesses, which are only very tiny within the group, have great optionality. I think SEEK will perform well.
Is there anything specific so far that you've actually seen that you've been really impressed with out of the earnings seasons, Jeremy, that you've really sort of gone, that is beaten, or actually disappointed probably is probably the other side to look at here?
Look, in terms of themes, apart from that cost management, which again weren't really anticipating companies would have gone that well, we do look at stocks quite individually. So today I was in conference calls from QBE, and there were some good elements in that as well as some disappointing ones. Invacare, and again costs came through there as very, very good, and in a very morbid sense, a return in a higher death rate towards the end of the fiscal half year was again a bit of a boon for them. Look, I would say, and other businesses like JB Hi-Fi, I found that an interesting result, where the mix of sales is changing. So, you know, I look at it very individually, and I'll form a view on companies across the board. Generalisations, you know, do tend to make the press more, but I mean, we invest individually in the companies. So we liked Invacare. We've very much been a long-term investor, not surprised by the rally. I like some of the things QBE was saying today. The divestment thoughts, and I want to hear more about this as we go forward, and I'm interested in the idea of partially IPOing their LMI business, their lending mortgage insurance business. Genworth has been a very good portent to how that could go. But also that their earnings aren't in a total state of disarray. There's patches of good inside that difficult business at the moment. So I'm finding that, you know, the best thing I can say to an investor is look at the stocks individually, and the different sectors and different kinds of companies all performing quite differently. So giving a catch-all phrase can be difficult when we're talking about different sorts of companies.
So that record high when it hit $55, I think off the top of my head. Jeremy, to you, it is a bit of a darling, as David alluded to. It's certainly been one that I myself have been quite strong on. I think it's got an incredibly good model because whenever the Aussie dollar goes down, it's got its international assets to offset any issues there and vice versa. So fundamentally now, where does Flight Centre go, where they probably do look slightly fully valued, and we are starting to see consumer discretionary spending sort of globally starting to plateau. So what's your thoughts there?
Yeah, I'm not really worried about the macro side of things for Flight Centre. I think they're undervalued at the moment. I think they're worth about $52. You know, there will be times of a bit of softness in their price related to, you know, particular announcements and particular patches of earnings. And we know that they gave a little bit of a warning about a month ago, just saying that it had been a little bit softer at the end of the financial year. But that, you know, just saw them sold down quite a bit and probably is really more of an opportunity, we think. So they're on a PE of around 15 times, and their return on equity is about 25%. So that is in a very attractive zone for a business. If you can find companies like that, returning like that, excellent. If they've got a strong balance sheet, so it's not geared up, and this is a company with stacks of cash on the balance sheet, it's even more attractive, and it can command a higher multiple. It pays a bit of a dividend, around 3-odd%, so that's handy. But it's a good quality business. You always want to buy them as cheaply as you can, and I think you have to. That's important. The one thing I'd say is I don't think there's $20 of upside or something in this. So you have to buy it. I need to buy it around 42 to make sense to want a stock which is worth 52. That's a margin of safety that makes sense to us. But we like it. It's about buying it at the right
What's your
price.
thoughts on Suncorp?
It's definitely going down tomorrow.
Yep. Dividend day.
It's ex-dividend. So, Richard, it's ex-dividend. It had a special dividend, total of 70 cents fully franked. Massive dividend, and so that's what's got a lot of appeal into the stock in the last week. A good result, and the dividend-hungry investors have climbed into Suncorp. I describe it as a hold now. It'll be great to get the dividend from tomorrow, but while I see parts of interest there, it's 2/3 insurance, only a third banking, and totally, as Evan said, the life side of their business, the risk insurance business, and in particular income protection, is a bit of an issue at the moment, and there's been claims across Suncorp, AMP and other insurers locally that have caused losses and rewriting down of their books. Overall though, the rally up is because the mortgage book in Queensland has got the pressure off it, and property prices have risen in that southeast Queensland corner, and that means that the dodgy state of their mortgage book in 2008 to 2011 is no longer. It's actually looking healthy again. So Suncorp is back in town. Its share price is re-rated accordingly. I wouldn't buy it at the moment, Richard. I would hold it if I had it. I don't think I'd sell it because I think over the next little while, though I don't expect a lot of share price movement, there is still capacity for this to rise a little bit. And it will pay, quite apart from the special dividend, a very attractive regular dividend. So it will reward you in that way. I think probably the best things we can say, just to reiterate what David said, there is no buyback on BHP. It was rumoured, it hasn't happened. Telstra is a good example because it's live at the moment. Telstra have announced last week they are going to do an off-market buyback. It's $1 billion in size, and people tender or offer, just to get the terminology right, offer being to sell their stock into the buyback. And you can tender them at a minimum of 6% discount to the share price or a maximum of 14%, and that's the range at which it will be done. Now, half of that will be capital, and the other half will be a fully franked dividend. And for somebody selling in, there might be a marginal benefit for selling into that buyback. Almost guaranteed is it'll be done at the bottom end of that range, 14% discount, because this is a well-beaten path now, the off-market buyback, and the value of the fully franked dividend involved is worth a lot to those on low tax rates, in particular those in the allocated pension phase in their super fund. So there'll only be a small amount accepted in that Telstra buyback, but it will be advantageous for a lot of people to take that up. they'll guarantee taking up the first 975 shares that you tender, and they won't leave you with any less than 325. So almost guarantees 1,300 shares will be taken up. Now, in dollar value to a lot of Telstra shareholders, that's not a lot of money. So it will only be marginal. And so do look at that if it's Telstra. BHP, it's not happening for now. They may do it at a later date, but it's not something for us to be considering right at the moment.
Jeremy, to you, expectations for Thursday and your general sort of perspective on where you see it?
Not a preferred stock in the space. AMP, I hate to say, never one that the brokers love because they used to dominate all the institutional broking panels. But as a business, I just don't see it doing any of the number of things in the financial services in a leading way. And their earnings growth has been dismal over a longer period. That's, I think, because they're confused about what they actually stand for. They're not the best fund manager. They're not the best dealer group. They're not the best financial planner. They're a tiny bank. They're in a few little things as well. They don't do any of it particularly well. I prefer a pure play that does their own thing better. And I like a number of the listed fund managers. Platinum Asset Management is a preferred one there, and they're due to report. They pay a much higher dividend, have a much higher return on equity, about 3 times AMP's return on equity. So the same dollars invested in the business, not the shares, will return 3 times as much. So I far prefer that. I think their costs are a lot lower. And they're a business with greater scalability, which we look for. Now, AMP might surprise on the upside with its result, but at $5.50 I see it a little bit overvalued and certainly less attractive than others in the same sector. There is hope for NAB. It deserves to get hit for what it's done. It's been so long out of the leading part of the bank sector. There is potential for it, definitely, to turn around. It's the cheapest and it's the ugliest house on the block. Under Andrew Thorburn, the opportunity is to get rid of the UK assets, which have been a laggard, and to generate better margins in the Australian market. Massive dividend in this market.
I think that's